This video is on building credit safely. Um, for many people, building credit can seem like a catch-22. You need good credit to apply for many of the best loans and credit cards, but you can establish credit without those loans and credit cards. Many lenders don't want to take the risk of extending credit cards to someone with no history of repaying credit. While their logic makes sense, it doesn't help the roughly 26 million Americans who have no credit history with a nationwide consumer reporting agency. Thankfully, you may have more options to start building your credit than you may think. You've got to start somewhere. The first step to building credit is knowing where you stand. If you think you may already have a credit history, you can check your credit scores at Credit Karma for free. I have an app on my phone called Credit Sesame, which tells you your score and gives you tips on improving it. Keep in mind, though, that you may not have a credit scores if you just opened your first account. You need to have at least one account open for 6 months and at least one undistributed account reported by a creditor before it can be used to calculate a credit score. So some tips you can do is you can get a parent or a close friend to co-sign a loan. If you're in need of a loan in an immediate future but have no credit to speak of, your best shot at getting approved may be to get a co-signer for your loan. Having a co-signer can move you up on the scale as far as credit worthiness. A co-signer guarantees the loan, generally meaning they're on the hook to pay back any money owed if you can't. Since this lowers the lender's risk, it can help you get approved for a credit card or loan, even if you have little or no credit. Of course, not just any co-signer will do the trick. If you have no credit, you'll want a co-signer with excellent credit to help you qualify for a low interest rate. See, I can do that option because everyone I know, the parent or, whoever you use as a co-signer is taking a lot of risk themselves, so a lot of people won't do it. But one thing you can also do, too, is apply for a secured credit card. If you don't need credit immediately but want to start building your credit for the future, a secured credit card could be a great option for you. Secured credit cards are called secured because they require a cash deposit that serves as collateral if you miss a payment. In most cases, the deposit will also serve as your credit limit. After you've approved and have put down at least the minimum deposit, a secured card works similar to an unsecured credit card. You make charges and pay off the balance. The big difference is that the security deposit is available to the credit card company in case you default. This lowers the company's risk since it can take any money you owe out of the deposit it already holds. If you do ever owe more than your security deposit, you'll still owe the difference even if the lender sees your deposit. Another thing you can do is apply for a credit builder loan. The main purpose of the credit builder loans is to build your credit, typically offered by credit unions. These are small loans, typically less than $1,000. That aren't really loans at all, at least not in the traditional sense. So here's how they work. First, your financial institution deposits the amount into a locked savings account you can't access. Once the loan is fully paid off, the accumulated money is returned to you in total. While these loans may seem pointless at first glance, they can be powerful credit building tools. Your payments are reported to the credit bureaus, and responsible payments over time can help to build a credit. Small local banks and credit unions are more likely to offer credit builder loans than big banks because these smaller institutions are generally more invested in building up their local communities. To get you started, check with local banks and credit unions to see if they offer a credit builder loan that you qualify for. I did this with my bank at Key Bank. Having this loan and my checking account through them has actually also improved my relationship with them. So next was become an authorized user. If your parent, significant other, or a close friend makes you an authorized user on your credit card, you might see a small credit boost. This method isn't guaranteed to work, as not all credit card companies report authorized users' activity to the major credit bureaus in the same way that will help them build credit. Another one is get your rent payments reported to the credit bureaus. Mortgage payments usually show up on your credit reports. Unfortunately, renters don't typically enjoy the benefits of having their payments show up on their credit reports. In fact, most landlords don't report rent payments to credit bureaus at all. Thankfully, there are ways to get your rent payments reported to the credit bureaus on your behalf, but it will likely cost you. So what are the key components to a healthy credit score? While applying for a secured credit card or credit builder loan, maybe the first step on your journey to building credit, they definitely aren't the last. If you want to see continual improvements in your credit health, you'll need to make sure that you use your credit responsibly. That means paying attention to all the factors that go into your credit scores. Here are a few tips to help you keep on track in 5 major areas: your payment history, amount owed, the length of your credit history, your new credit accounts, and your credit mix. So first we're going to talk about payment history. While different credit scoring models weigh factors differently, payment history is generally a high impact factor. Late or missed payments can have a real impact on your credit scores. So always try to pay your bills on time. If you can't pay off all your credit balances in full each month, at least make a minimum payment to avoid late fees. So next we have accounts owed. This factor refers to your credit utilization, or how much of your available credit you're using at any given time, and your total balance it owed. Credit utilization is calculated by dividing your total credit card balances by your total credit card limits. Most experts recommend keeping your credit utilization below 30%. Doing this suggests to lenders that you don't spend outside of your means and can use your credit responsibly. Then we have the length of the credit history. If you're just getting started building credit, there isn't much you can do to affect your length of your credit history. However, going forward, you'll want to seriously consider keeping your oldest credit card line open to keep the length of your credit history from shrinking. New credit accounts. Too many hard inquiries into your credit can actually lower or damage you. Lenders typically don't like to see you open multiple new accounts in a short period of time because it suggests a higher risk of potentially defaulting on a loan. While you need a new credit card to build your scores, focus on opening just one account at a time rather than many at the same time. So credit mix. Basically, credit mix looks at the different types of credit accounts you have open. These may include credit cards, installment loans, mortgages, and other types of credit. As someone new to building credit, you shouldn't take out a loan simply to fulfill a credit mix portion of your scores. Over time, you'll slowly build this small portion of your scores as you progress through life's big events, such as buying a car or a home. So, what's next? Building credit without having credit is frustrating. It seems like a catch-22 you simply can't escape. Rather than getting frustrated or just giving up, use the tips I laid out above prior to this video. To begin establishing credit, as soon as you open your first credit line, make sure you use your credit responsibly to help improve your credit over time. So there are 5 big credit card mistakes people should avoid. Number 1 is pretending credit doesn't exist. If the only credit card advice you ever got was don't use one, you may want to get a second opinion. The truth is, credit cards can be a great tool for building credit if you use them responsibly. That's a great big deal because you'll need good credit when you start adulting. Lenders may look at your credit when determining whether they'll rent you an apartment or approve you for a loan. So if a car or a home or apartment, it's not an idea to start working on your credit scores now. Your credit scores are 3-digit numbers, typically ranging from 300 to 850, that lenders use to evaluate the probability that you'll repay your debts. According to a 2016 Student Monitor report, students with a credit card in their own name reported having a mean credit score 50 points higher than students without a credit card in their name. So the other thing is missing payments. When you're juggling essays, midterms, it can be easy to miss a credit card payment, and missed or late payments have consequences. Young adults are especially vulnerable to late fees. 3, running up credit card debt. If you have a credit card balance, make a plan to pay it off. But using money earmarked for another necessity expense like rent won't help. We want to pay debt as quickly as possible. So putting more towards it than we can realistically afford means having to put our spending on the card again. Just because you get a big kid job right now out of college and you're getting paychecks now, doesn't mean you can spend. So 4, not setting a budget. If you're not tracking your finances, you won't know if you're running more debt than you can handle. Learn how to live below your means. Um, to create a budget, start by listing your monthly income, including income from any jobs, and then list your monthly expenses. To keep yourself motivated, write down the goal. Do you want to save up for a purchase, add to your emergency savings, or simply stay out of debt? And then 5 is not understanding how APR works. The terms and conditions that come with a credit card can be harder to understand than that second semester professor who mumbled. APR is one detail that many college students simply don't get. When you charge a purchase to your credit card and don't pay off your balance in full by the date your payment is due, it accumulates interest. But if you pay your balance off each month, you won't pay interest on that balance. Generally, credit card companies offer a grace period for new purchases. This period is a gap between the end of your card's billing cycle and the date your payment is due. With most credit cards, if you pay off your balance in full and have no outstanding cash advances, you won't be charged interest on new purchases during the grace period. Heads up though, if you make only the minimum payment every month, you could be inviting debt. For example, for a $1,000 balance with an APR of 21%, it will take about 5.5 years to pay off the balance, and you'll pay about $662 just in interest. Make sure you know the following details of your credit card: your balance, the date your payment is due, the purchase APR and the penalty APR, the date your introductory APR ends, if applicable. So what's the bottom line? Many people can avoid making credit card mistakes. It just takes some diligence and know-how. By setting payment alerts, charging only what you can to pay off, tracking your spending, and knowing your credit details, you can start life after college or anytime really with positive credit and no credit debt. So my personal experience. I started about 2 years ago building my credit. I found an unsecured credit card through Capital One. I also had a credit building loan through KeyBank, like I mentioned before. After having these for about 6 months, I added another credit card through Chase. I did make the mistake of running these cards up and not paying the balances off completely and only paying the minimum amounts. This made my credit score around the 600 mark. Recently, for my own financial wellness, I switched to a better checking account and paid my credit cards completely off. My credit score is now in the 700 to 750 range, the last I checked. But thank you for listening.